Hello, fellow traders. Let's be honest, these markets can be nerve-wracking. I've seen enough market ups and downs to fill a book, and today I'm sharing my playbook on hedging. These strategies I use to protect my own portfolio and portfolios of friends of mine. We'll cut through the jargon and focus on the practical strategies you can use now to safeguard your investments. By the end of this video, you'll understand why hedging is essential, and how to implement specific strategies, and how to tailor your approach and an individual risk tolerance. Today we're going to get into portfolio hedging techniques for volatile market conditions by a pajama trader. Let's get into it. Understanding market volatility, the real deal. What is volatility? Not just price swings, but the rate and the magnitude of those swings. A volatile market can change direction quickly and dramatically. What causes it? Economic releases, inflation data, GDP reports, interest rates, decisions by the Fed. Geopolitical events, wars, trade disputes, political instability. Investor sentiment, fear and greed drive market movements, often irrationally. Current market. The S&P 500 is down, negative 2.24%. This isn't just a dip, it's a sign of potential trouble ahead. Give this a like if this is connecting the dots with you. Share this with other like-minded traders looking to change their trading game. And consider subscribing for more Market Edge videos like this one. Your hedging toolkit, core strategies. Diversification, spreading investments across different asset classes like stocks, bonds, real estates, commodity, and even cash. How it works: reduces risk by limiting exposure to any single asset or sector. If one investment performs poorly, the others can offset the losses. Short selling, borrowing shares and selling them, hoping to buy them back at a lower price for a profit from the decline. Pros, potentially high reward if the stock price falls. Cons, unlimited risk if the stock could theoretically rise infinitely. Requires a margin account also. Options, puts, buying the right but not the obligation to sell an asset at a specific price, the strike price, before a certain date, the expiration date. How it works: it's like life insurance for your stocks. If the stock price falls below the price or the strike price, your put option gains value, offsetting your losses. Inverse ETFs, exchange traded funds that are designed to move opposite to the market, index, or sector. How it works: a simpler way to bet against the market. If the index or sector declines, the inverse ETF increases in value. Caution: they can suffer from decay over time due to the way that they're structured. All right, let's get down to the tools that you can use today. Diversification is your bedrock. Don't just own a handful of tech stocks, bonds, real estate, or commodities. Spread your risk. Short selling is a more aggressive tactic. It's not for the faint of heart. You're essentially betting against a company. Options are like buying insurance. You pay a premium, but protect yourself from disaster. And inverse ETFs, they're simple, but be careful. They can be tricky due to something called decay. So understand how they work before you dive in. Sector rotation, playing defense like a pro. What is sector rotation? Shifting investments into sectors that are expected to perform well during specific phases of economic cycles. Defensive sectors, consumer cyclicals, XLP, utilities, XLU, healthcare, XLV, tend to hold up relatively well during economic downturns. People still need to buy groceries, pay their utility bills, and seek medical care, even in a recession. Cyclical stocks, technology, XLK, consumer discretionary, XLY, financials, XLF, are more sensitive to economic changes. These sectors tend to outperform during economic expansions, but underperform during contractions. XLP, consumer staples, down negative 1.0%. XLU utilities, down negative 0.90%, while XLK technology is down negative 3.47%. Now we're going to get strategic. This is where you can really outperform. Sector rotation is about anticipating market trends and positioning your portfolio accordingly. While overall markets are down, tech is getting hammered. Consumer staples and utilities are holding their own. Why? Because these are essential. Goods and services is what people need, and they use. People need them regardless of the economy. So a smart move might be to reduce your exposure to tech and increase your allocation to staples and utilities. Case study: from tech wreck to portfolio check. Scenario: portfolio heavily invested in tech stocks. Example, 70% in XLK. And the tech sector is facing headwinds. Example, rising interest rates, slowing growth. Action: buy put options on XLK to protect against further declines. Short specific tech stocks that appear overvalued and vulnerable. Reduce overall exposure to the XLK and reallocate to more defensive sectors like the XLP or XLU. The result: reduced losses compared to holding tech stocks outright, and the portfolio is better positioned to weather the storm and potentially profit from a market recovery. Let's say you've ridden the tech wave and now you're sitting heavy on a pile of tech stocks. You're feeling a bit uneasy, and rightfully so. Here's what I'd recommend. First, buy some put options on XLK. That's your immediate downside protection. Second, identify any tech stocks in your portfolio that look particularly vulnerable and consider shorting them. Finally, the most important, rebalance. Take some profits from your tech winners and move that money into something more stable like consumer staples or utilities. This is about protecting your gains and protecting for what's next. Hedging hazards. What to watch for. Hedging costs. Premiums for options, borrowing fees for short selling, transaction costs. These costs reduce your overall returns. Opportunity costs. You might miss out on the potential gains if the market recovers quickly and you're hedged. So your hedges will limit your upside. Complexity. Some of your hedging strategies, like options trading, require expertise, careful monitoring, and active management. Don't jump in without understanding the risk. To be upfront with you, hedging isn't free lunch. There are costs involved. Those option premiums, those short selling fees, they all add up. And here's the thing, if the market turns around quickly, you're going to miss out on some of the upside because you're hedged. Plus, some of these strategies, especially options, can be complicated. If you don't know what you're doing, you can lose a lot of money. So do your homework and don't be afraid to ask for help. Your portfolio, your peace of mind. Hedging, a crucial tool for managing risk in volatile markets. It's not about getting rich quick, it's about protecting what you have. Choose the right tools and strategies for your specific portfolio, risk tolerance, and investment goals. Stay informed, stay prepared, stay calm. Market conditions can change constantly, so your hedging strategy should be dynamic and adapt to your current environment. So what's the bottom line? Hedging is essential, but it's not one size fits all. It's about understanding your own risk tolerance, knowing your portfolio inside and out, and choosing the right tools for the job. The most important thing is to stay informed, stay prepared, and don't panic. Market conditions are always changing, so your hedging strategy should be flexible and adaptable. With a well thought out plan, you can navigate volatility with confidence and protect your financial future. Thanks again for watching.